Inflation, which has become a very critical problem globally, has become the main focus of many countries. At this point, many countries are under the leadership of the federal interest implemented a policy of increase. This policy, which has been actively going on for a while, although it is slowly beginning to bear fruit, brings with it some problems: recession. At this point, the Fed is trying to balance by signaling the brakes in the minutes off the Federal Open Market Committee (FOMC) meeting announced last Friday. Fed's proposal to break rate hike could benefit developing countries. The solution to the inflation problem, which has become a crisis globally, was found in the policy of interest rate hikes, especially the Fed, which has been aiming to regain control of inflation data by raising interest rates for some time, lit the first break light in the minutes of the November 1 to 2 Federal Open Market Committee (FOMC) meeting announced on Friday. The majority of respondents agreed that a slowdown in the pace of rate hikes would soon be appropriate, leading to a global wave of falling bond yields, rising stock prices and a rise in various currencies against the dollar. More importantly, the fact that the Fed thinks it has reached a stage where inflation can be brought under control raises hopes of a soft landing for the U.S. economy. Major central banks such as the European Central Bank, ECB, and the Bank of Japan are also clearly expected to benefit. Emerging economies hurt by rising borrowing costs and a double blow from depreciating currencies will also benefit most from the Fed's slowdown in rate hikes, experts say. S&P Global executive Paul Waters, who made a statement on the subject, lost the following statements. Many emerging markets, such as Latin America, have peaked at fairly high rates and are poised to respond if the Fed accelerates its rate hike.